Welcome to The Explainer. Today, we're decoding TC Energy's financials to find the real truth behind the stock. So, the big question, is this energy giant still a safe long-term compounder at today's price? Let's dive in. Think of TC Energy like a massive toll road. They earn stable, contracted fees, totally dodging crazy commodity swings. This builds an absolutely killer moat. We're talking huge scale, long-term contracts, and crazy high regulatory barriers. And wow, it pays off. That dominance drives a super strong 47.5% operating margin. Plus, their free cash flow is skyrocketing, recently hitting a massive $3.79 billion over the trailing 12 months. Throw in a nearly 4% dividend yield, and it seems like the ultimate income machine, right? Well, hold up. Every story has a twist, and their biggest red flag is definitely the balance sheet. Brace yourselves. TC Energy is lugging around a jaw-dropping $61.87 billion in total debt, with debt-to-equity hitting 166.5% and a 0.65 current ratio. Short-term liquidity is seriously tight. In our world of high interest rates, that debt mountain really crushes profitability and limits their strategic moves. So, matching that brilliant moat against a massive debt anchor, what's the stock actually worth? Right now, the market values TC Energy shares at about 88.61 Canadian dollars. But if we're conservative, the actual fair intrinsic value sits right around 77 bucks. Yep, the scales tip. The stock is currently trading at a premium above its true intrinsic value. As our source notes, right now it behaves way more like an income holding than a deep value play. To snag a 9% annual return over 16 years, your target buy price drops to $59. If you want to heavily accumulate shares, you really should wait for that $60 to $68 zone. On the flip side, if shares spike past $100, it's probably time to start trimming your position. Weighing the whole shebang, TC Energy gets a moderate final risk score of 6.1 out of 10. And for opportunity, it scores a solid, though not totally mind-blowing, 6.7 out of 10. The final verdict? It's a stellar business with a rock-solid moat, but the balance sheet is highly leveraged. So the recommendation is a firm hold. Honestly, just wait for a lower entry point before buying in. The big question for you, do you have the discipline to sit tight and wait for that price drop?